Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Suncor stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Suncor's specialty is the production of synthetic crude from oil sands. This is just one of many ways to extract oil. The sand is removed from the ground and put into trucks, which are brought to crushers, where the large clumps of earth are processed. Once the oil sand is crushed, hot water is added so it can be pumped to the extraction plant. That is what you call the upstream part of the oil and production process. Since Suncor is an integrated oil and gas company, it is also involved in the downstream part of the process, which is refining and marketing. The company is headquartered in Calgary, Alberta, Canada, and was founded in 1919. The ticker trades on the TSX, New York Stock Exchange, Mexican Bolsa, Deutsche Börse, and Swiss Stock Exchange. We're looking at the ticker that trades on the TSX, so all the numbers in this video are Canadian dollars. Let's get started with the model. This is a large cap company. 73 billion market cap. They're trading at $52 a share, and they have 1.4 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They had nearly $5 billion of free cash flow in 2019. 2020 was a rough year due to COVID and less demand for oil. Then everything bounced back in 2021. They had over $7 billion of free cash flow. It's even better in the trailing 12 months at $7.7 billion. Net income is a profit or loss on the income statement. It's revenue minus expenses. That's also negative in 2020, but highest in the trailing 12 months at $6.2 billion. Revenue is a sales for the company, and that almost doubles from 2020 to the trailing 12 months. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, and that was highest in the trailing 12 months at $22 billion. Below that is our operating expenses. These are all the expenses not directly related to generating the revenue. Gross profit minus operating expenses gives you your operating income, and that was over $9 billion in the trailing 12 months. They paid $1.2 billion of interest on their debt, which is pretty similar to prior years. Then you have other income and expenses. These are all the gains or losses not part of the company's core operations. Below that is their pre-tax income, then their taxes, and the bottom line of the income statement is their net income, which is highest in the trailing 12 months at $6.2 billion. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. So you can see how much cash flow they're generating in the trailing 12 months, over $12 billion. The higher the price of oil, the more cash this company generates. And the lower the price of oil, the less cash they generate. Since the price of oil is over $100 a barrel, this company is making money hand over fist. They always have a lot in CapEx, nearly $5 billion in trailing 12 months, because they have to build out a lot of infrastructure. Operating cash flow minus CapEx gives you your free cash flow, and that was $7.7 billion in trailing 12 months. So they do pay a nice dividend, but another way to reward shareholders is to buy back stock. In the trailing 12 months, they bought back $2.8 billion of stock. They've also been paying down a lot of debt. They paid down $2 billion in the trailing 12 months. Let's look at their capital structure. They have $38 billion of equity, $18 billion of debt. They're 68% equity, 32% debt. And I gave them the middle whack on Finbox, 8.8%, and that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $82 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $79 billion. We divide that by 1.4 billion shares. And we get a calculated stock price of $56. They're trading at $52, so they're trading at a 7% discount. It's a buy according to the model. The last time I did a video on this company was 3.5 months ago. They were trading at $38 a share. My price target was $46. And they've already beat my price target since they're at $52. With the price of oil getting so high, plus the tension with the war in Ukraine, And also high inflation has really helped oil and gas stocks. Their revenue is projected to decline over the next few years. Their 2024 revenue target is 46 billion Canadian dollars. 2023 is 52 billion. 2022 is 60 billion. And I continued this growth into 2025 and I got 41 billion. That's how I got their future revenue estimates. They convert on average 12% of their revenue into free cash flow. So I multiplied their future revenue estimates by 12%. That's how I got their future free cash flows. The website Simply Wall Street is at 106. They're saying the stock is 51% undervalued. 10 analysts priced the American stock. The American stock is trading at $41. The average price target is 42, the lowest 36, the highest 47. This top chart is the company's stock price the last 5 years. In July of 2018, it hit $55. Then it bottomed out at the beginning of COVID, around $17 it looks. And it's nearly tripled since the bottom. This bottom chart is the price of Brent crude the last 5 years. So you can see their stock price is highly correlated to the price of Brent crude. They pay a quarterly dividend and they recently doubled their dividend from 21 cents to 42 cents. So their yield is 3.25%, which is 38% of their net income, 31% of their free cash flow. The next time they pay a dividend is on 6/24. The ex-dividend date is 6/2. So if you own the stock before 6/2, you'll get this dividend. But if you buy the stock on 6/2 or after, you will not get the 6/24 dividend. Here's a chart of their dividend yield since 2011. It was under 2% in 2011, then hit 4% in 2019. Then when the stock crashed during COVID, the yield shot way up to almost 7%. And the forecast is for the yield to be 4.2% in 2024. They have a pretty high beta, 1.85, so the stock is a bit volatile. It moves almost 2 times the market. It's gone up 84% in the past 52 weeks, while the S&P is down 1%. The 52-week low is 22, the high is 52. And the stock is trading above its 50-day and 200-day moving average. This is a really popular stock. 11 million shares are traded each day. All the shares outstanding are on float. 62% are held by institutions and 1.25% are shorted. The last time they did a stock split was 14 years ago. They did a 2-for-1. Before that, a 2-for-1 in 2002, a 2-for-1 in 2000, and a 2-for-1 in 97. If you invested $10,000 into this company 10 years ago, you would have been down on your investment after 9 years. But if you're still holding on, you would have doubled your money. That's 100% return or 7% annual return. The CEO's annual salary is 1.2 million Canadian dollars. The total compensation package is almost 12 million Canadian dollars. In the past 12 months, there's been no insider selling, just buying. So I'm sure all these people are happy because the stock price is higher than the price they purchased it at. 60% of the company is held by institutions, 40% by the general public, and a small percentage by insiders. It looks like they added a bunch of employees the past year. They're currently at 16,900. Vanguard is the biggest shareholder at 3.4%, then Dodge & Cox, Fidelity, RBC, and Sanders Capital. Let's look at their financial ratios. A really good PE of 12, that's stock price over earnings per share. The market median is 20, the market average is 30. Price to sales of 1.6, price to book of 1.9. And look at that price to free cash flow, it's below 10. Their return on invested capital is 14%. They can cover their interest payments 7.5 times. Their ROE is 16%. The market median is 7%. They can cover 120% of their current liabilities with their current assets. And their quick ratio is 0.7. In the trailing 12 months, they generated 7.7 billion of free cash flow. They have 2.2 billion of working capital, and they paid out 2.4 billion in dividend payments. So it looks like the company is pretty well funded. The best way to look at ratios is to compare them to companies in the same industry. There are 20 companies in the same industry as Suncor. And if Suncor has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. I converted all these numbers to Canadian dollars. They spend a lot less in CapEx than the average company. Their debt to equity ratio is a little better than average. They pay a nice dividend, higher than average. Look at Petrobras, 14%. They don't generate as much free cash flow as the average company. They're the 10th largest company on this list. Their market cap is 73 billion Canadian dollars. The average company is 122 billion Canadian dollars. Their price to book is a little worse than average. Their PE is better than average. But even though they have a really good price to free cash flow, the average is so low in this industry because oil companies are generating so much cash these days with the high price of oil. Their price to sales is a little worse than average. Of course, they generate less revenue than the average company because there's some really big companies on this list. Their 5-year annual revenue growth rate is 8%. The average is 16%. They do have a better ROA than average. That's net income over assets. It's how well you use your assets to generate a profit. And their ROE is better than average. They're 16%, the average is 7%. To summarize, I have them trading at a 7% discount. But if you bought this stock within the last 6 months, I'm sure you're really happy. They've been doing great. Pretty much any stock in the oil and gas industry has been doing really well lately. Commodities tend to be a good hedge during a bear market. And this company is great for a long-term hold because you get your consistent dividend. I rank their free cash flows 9 out of 10, their revenue 9 out of 10, and their ratio 7 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.